Okay, let's dive right into this because today we are looking at something absolutely fascinating. Welcome to The Explainer. We're going to explore the stock market, but, not as that intimidating, chaotic casino you always see in the movies. Instead, we're going to look at it as a brilliantly simple historical machine, a tool that was literally designed to build collective wealth. If you're a new investor trying to make sense of it all, well, you're in exactly the right place.
So I want to start by posing this grand question directly to you. How exactly do global enterprises accumulate billions of dollars? I mean, how do they afford to build massive infrastructure projects, create groundbreaking tech, and employ millions of people all over the world? To really understand this, we've got to strip away all the complex charts, the breaking news alerts, and those shouting traders on the floor. Underneath all of that noise, at its absolute core, the stock market is just a highly structured marketplace. It's simply a place where people come together to buy and sell ownership in companies.
Here's a quick look at our journey today. We've got 5 parts. 1. The origins of collective wealth. 2. The modern market and IPOs. 3. The supply and demand seesaw. 4. Daily noise versus long-term trends. And finally, number 5, your financial independence. All right, Section 1, Origins of Collective Wealth, from spice ships to shares. Now, this whole system, it wasn't actually invented in the giant glass towers of Wall Street. It started centuries ago. Think of the Dutch East India Company back in the 1600s. Back then, sending a wooden ship around the globe for spices and silks was a highly dangerous, astronomically expensive venture. I mean, if you funded a ship all by yourself and it sank, you lost absolutely everything. The risk was just way too high. So, enterprising voyagers came up with a really revolutionary solution. First, they divided the entire cost of the voyage. Second, they sold structured units of the venture to anyone willing to provide capital, which effectively spread that immense risk across a whole bunch of investors. And third, if the voyage succeeded, well, everyone shared in the spectacular collective profits. In exchange for their money, those early investors received a structured certificate, a genuine share of the future profits. By doing this, they made these massive voyages affordable through collective wealth. If the ship actually returned fully laden with goods, everyone who owned a share profited together. Unknowingly, these coffeehouse traders and harbor operators had created the world's very first stock market concept. It was a brilliantly simple idea that fundamentally changed human history and totally set the stage for modern finance. Moving on to Section 2, the modern market and IPOs, upgrading the machine. Today, that exact same core principle of the spice ships remains unchanged, though, the execution is a little bit more complex. Imagine a modern tech company needing millions of dollars to build manufacturing facilities and hire top engineers. Usually, they start by getting funding privately, but eventually they aim for a monumental milestone. So the crucial point is the IPO, or initial public offering. This is a company's grand debut on the official public market. At this precise moment, their private certificate of ownership turns into a publicly tradable unit, a stock. And this is exactly when the doors open wide to everyone, from giant global hedge funds to everyday investors just like you and me. When you use your standard portfolio account to buy that stock, you aren't just buying a random ticker symbol bouncing around on a screen. Buying a stock makes you, in a very genuine and highly structured sense, a partial owner of that business venture. Your investment provides the vital capital that the company needs to execute its ambitious growth plans, build new factories, and innovate. And as they succeed, the increased public interest and collective wealth boosts their overall market value, which in turn increases the value of the stock you hold. Basically, everyone wins together. Now for Section 3, the supply and demand seesaw, the relentless dance. Of course, the market isn't just going straight up all the time. We absolutely have to acknowledge the emotional hurdle of investing. The market operates on this constant seesaw effect, a relentless dance between supply and demand that dictates a stock's daily value. Look at it this way. If everyone believes a venture is going to be super profitable, buyers outnumber sellers, demand increases, and the price just climbs higher and higher. But the reverse is also true. If a company faces sudden negative publicity, or maybe looks a little less profitable, human emotion kicks right in. Investors rush to sell to secure their profits. And when sellers outnumber buyers, demand plummets, and that sudden surge in supply forces the stock price down, genuinely dropping the company's market value. Which brings us to Section 4, daily noise versus long-term, navigating the turbulence. This is a core lesson for any new retail investor. That seesaw we just talked about, it is heavily influenced by a sheer volume of human emotion and just endless variables. Think about what companies and investors are constantly reacting to every single day. Fluctuating material costs, new production technologies, shifting labor expenses, unexpected changes in leadership, bad news cycles, new trade laws, shifting tax policies, massive global economic headlines. It's literally overwhelming. And on top of all that, sometimes investors simply decide to sell just because they want to take their money and pursue a totally different personal venture. All of this creates a relentless spinning turbulence. And this brilliantly illustrates the crucial distinction we need to make today. All those variables create day-to-day fluctuations. That's the noise. It's the noise that makes investing seem like this complex, unpredictable game of chance. If you try to jump in and out of the market based on daily noise to make some quick cash, you're just fighting against random human emotion. But long-term trends, those represent rational, structural growth. Real wealth isn't built by reacting to yesterday's news cycle. It's built by identifying solid companies and holding on to them as they innovate and grow over years and even decades. I really want to highlight this powerful thesis straight from our source material. While day-to-day noise is random, long-term trends tend to be rational. This difficult-to-track sea of human emotion is exactly why every true professional and wealth creator promotes the idea of a long-term structural investing strategy. They completely understand that over a long enough timeline, the daily panics and those temporary spikes fade away, revealing the true rational value of a growing business. Finally, Section 5, your financial independence, taking the wheel. Look, the entire stock market system is admittedly complex, but it is definitely not impenetrable, and it's certainly not just reserved for the powerful elite. We live in the digital age. Today, everyday investors like you have more control and access than ever before. You can utilize the exact same methods, the same research, and the exact same platforms that large global investors use to acquire and hold positions. By dedicating your time to actively educate yourself, you can strip away the noise, participate in the market, and put your money right behind the structural ventures and companies that you truly believe in. Which leaves us with this final thought. The machine of collective wealth, this centuries-old tool designed to pool resources, spread risk, and share in magnificent profits, is sitting right there. It's waiting for you to use it to build your own financial independence. But just like those voyagers boarding wooden ships centuries ago, the first and absolutely most important step in any successful venture is simply getting started. So, are you ready?